I'm going to show you in this video how investing a mere $25,000 per year can yield you $10 million in net worth. You don't even need to have hundreds and hundreds of units to do it. Buying one good property per year can get you that high net worth level by using compound interest in real estate. For those of you who are new to the channel, I'm Paul. I'm a value investor, and most of my videos are about stocks. But a lot of people don't know this. I own a lot of real estate. In fact, it's always funny to me that people who know me personally are always shocked to hear that I actually invest in stocks as well, because my real estate portfolio is so nice and large. At one point, we had 1,000 units and we sold our largest property off. So we're around 600 units right now. Real estate is a great way to build wealth. When I was 20 years old, I remember meeting my neighbor for dinner with my father. And he said to me, Paul, every rich person you know owns real estate. Now, obviously, that was a very generic statement, but as a 20-year-old who wanted to make a lot of money, it stuck with me. That week, I went back to college and I reached out to a real estate agent and said, I want to buy campus properties. I didn't pull the trigger quite then, but a year and a half later, at the age of 22, I bought my first property. And a lot of people think you need to buy a lot of really large properties to do it. No, buying one good property per year for $100,000, $125,000 is all you need to build a net worth, not a total value, a net worth of $10 million in real estate. Don't be confused. When people tell you they're a real estate millionaire, they're probably talking about their total asset value. I'm not talking about that. I'm talking about your assets minus the money you own on the real estate will be $10 million or more. So this is going to be a longer video, very detailed. It's really important that if you're interested in real estate, to rewatch this video beginning to end 2 or 3 more times, because I'm going to show you the mistakes people make commonly, as well as how you get into real estate to build it up there. So first things first, how do you get the money to get started? There are 2 main ways to raise money for real estate. First off, obviously, saving. Save on your own. If you can save this money and be your own partner and the only person you have to answer to, why is that a bad thing? It's not. Trust me when I say you want to be your own partner. But the second way to raise it is friends and family.
Salute, mi familia. Salute.
People who know you and trust you. If you sound knowledgeable, if you have a good plan going forward, you can go to friends and family and ask them, hey, are you willing to invest $5,000? Now, if you're watching this video and you don't think you can do that, you'll be surprised. People want to support the people they love out there. My family did. My friends do. Now I get friends and family saying, can I invest with you? And we're very selective about it. Why? Because we want the right partners. You're going to be your best partner. So first focus on that. But the next best partners are your friends and family. Don't go outside of other investors yet because you need a track record, but this will give you the track record you need in order to raise money from other people. So the next step is, how do you find a property? The first thing I'm going to tell you, and I'm sure somebody out there is a broker or realtor, so don't get too offended, but never, ever, ever trust a broker or realtor. Use them to merely feed you the property. You need to have your own way of evaluating. They are salespeople. They are not real estate investors. Let me tell you a story. And I have actually many stories, but here are 2 stories I have to tell you about a real estate agent and a broker. And you might sit there and say, oh, Paul, they're flukes. FYI, the second one, the real estate broker, was one of the founding members of one of the nation's largest real estate brokerage firms. Okay, so the first one's my realtor friend. Calls me up one day and says, Paul, I have a great property for you to buy. This was a flip. I said, okay, I'm looking at the numbers. I'm like, you know what? This doesn't make any sense to me. And she was like, Paul, this is a great property. Trust me. So I said to her, if it's so great, please take your commission and be a partner with me. To which she said, drum roll, please. Well, wait a second. Let me look at the numbers first to make sure the deal makes sense. I swear on my 4 dogs that I love very much that conversation occurred. Remember, they're still trying to take care of themselves, which I don't blame them for. But understand that going into it and realize that's the case. Second one, the major real estate broker. I was trying to close a deal once, and something happened with the bank loan on the other person's bank loan. I was acquiring their bank loan. Well, it turns out they gave me the wrong balance. They were off by about $8,000 or $9,000, which in the grand scheme, it was a $2 million loan, didn't matter. But to me, it was more about, hey, you guys were so inaccurate about the small thing. What else are you inaccurate about? The broker wrote me an email and said, you're going to get a tax credit of $11,000 or $12,000 at closing. What's the big deal about this $8,000 or $9,000? Now, for those who don't understand that, I can understand why it might be confusing, because you might be like, well, yeah, you're getting $11,000 or $12,000, they're getting $8,000 or $9,000. That $11,000 or $12,000 credit was coming to me day one anyhow, and I owe that money next quarter. Next year. The reason I get that credit is I have to pay for the taxes on the portion of the year that I did not own the property, because that's how property taxes work. You pay in arrears in Ohio. And I've been thinking to myself, my God, this person handles hundreds and hundreds and hundreds of millions of dollars worth of real estate transactions per year, and they didn't understand that the property tax credit was something that I owed again next year. Or if they did understand it, they were just being a salesperson, which is exactly what they were doing. So I repeat, do your own analysis. Use realtors and brokers to feed you deals, but be very clear with them up front that you do your own analysis and you're going to address that and you're going to give them the easiest commission in the world. All you have to do is feed you deals and feed the other side an offer. That's it. So again, the first one is realtors and brokers. Okay, now the second one, very simple. Do what I did first, friends and family. You might be like, well, Paul, you just talked about friends and family. I mean social media. Go on there and say, hey, everyone, I'm looking to buy a single family home in this area for rental. If you have something available or know of something, reach out to me. Could it yield something? I have no idea. But the good news is it costs you nothing to do it. It takes about 30 seconds of your time. If you do it once a month, people will know you're the person to go to. So someday in the future, when they do have something to show, they're going to come to you saying, oh, you know what? My friend Paul always posted he wants to buy something. Let me reach out to him. All it takes is that one time doing it, and it could lead to tens of thousands, hundreds of thousands of dollars in profit over your lifetime. Is that worth 20 or 30 seconds out of your day once a week? The answer is an obvious yes. Another option, cold call. Years ago, I was trying to prove a point. Now, cold calling is very difficult, and I got super lucky. And I'm even laughing about it now because of how insanely lucky I got. I owned a bunch of properties in an area called Shaker Heights in Cleveland. And I was driving down Van Aken Boulevard one day, and I see a building that has some overgrown grass. Doesn't look like it's in foreclosure, but it literally looks like maybe it's being ignored a little bit. I see a for rent sign. The for rent sign was this crappy Home Depot for rent sign. Pick up the phone. Lady answers. I said, hi, my name is Paul. I explained who I was. I said, I'm interested in buying your apartment building right off of Van Aken. She says, please hold for a second. I hold. Guy comes to the phone. Guy's named David. Hello, this is David. I said, hi, David. My name is Paul. I said the whole thing. I'd like to buy your apartment building. He said, okay. He said, can you tell me about yourself? Which I understood because he doesn't know me from Adam. It's a very common thing done by real estate agents and brokers to try to get deals. I said, I'm an actual investor. I rattled off some of the buildings I owned. He said, okay. I said, and I'm interested in buying your property. It would be an all cash deal. All I need. And then he said to me, what do you need from me? I said to him, I need 3 years of financial statements as well as your current rent roll. He said, okay, give me your email. So I hung up thinking to myself, oh, 1 for 1 on cold calling. This is incredible. Guys, and I'm not exaggerating when I say it was my first and only ever phone call to cold call for an apartment building. All of a sudden, 3 hours later, I get an email. All the information I asked for. The next week, we had a deal. We met for lunch. We shook on it. Ended up becoming one of my best friends. He passed away a few years ago, but he was an older gentleman. Awesome guy. But literally, I just picked up the phone and called when I saw that. That is a great way to do it. Finally, and it's kind of overdone, signs. You see those signs everywhere. I'm not a huge fan of them, but eventually, when the market cools down in real estate, these signs will start to probably go away, is my guess. So put those signs back up again, because when real estate's cool down, people will want to get out of their real estate a lot sooner rather than later. So these are 4 ways. If you hit all 4 of these ways up every single week, I can assure you, if you're trying to find one good deal a year, you'll not only find a good deal, you'll find a great deal once a year. And that is your goal. Find one really good deal every single year. So before I go into my analysis of how I look at a real estate deal and show you how real estate is such a great generator of wealth, first things first, when you start to look at the deal, I want you to remember that there's some very key things that people will leave out of their analysis. The first and foremost, real estate taxes. Now, they're not going to leave it out, but here's what they're going to do. The person before you bought the house a billion years ago for $50,000, and they're now selling it to you for $150,000. First thing you need to do, go to your county auditor and your county real estate tax and figure out where's the property currently valued at. Maybe it's at $80,000, because properties tend to not go up in tax value as much as that property value goes up. So when you buy the property for $150,000 and $80,000 is the tax base, your property taxes are going to almost double. But I assure you, the real estate broker or realtor is going to show you the current property taxes in their analysis. So let's say the property taxes are 2%. It's going to be $1,600 a year they're going to show you. But the second you buy it, it's going to go to $3,000 a year. Remember this stat right here, because when we go into our real estate analysis and I show you how you generate the income and growth in real estate, this will be very important. This is almost doubling one of your costs. Now you might sit there and say, it's only $100 and some a month. Okay, I get that. But it'll be amazing to show you how different your returns are when you do that. Another thing, ask for utility bills. Don't just ask them to tell you, what are you spending on utilities? Show me the bills. If they hem and haw on that one, red flag. You need to be able to see the utility bills. It wouldn't be the first time that somebody bought a property and all of a sudden it's like, oops, here's another utility bill we forgot about. What happened here? Well, if you do this and do that, there's always going to be an excuse for it. And once you own the property, it's nearly impossible to get out of that. You might sit there and say, I'll sue the person. Doesn't work that way. Third thing, homeowners insurance. So every property needs insurance. But remember, people do tricky things in their insurance. Your policy is going to be a lot different than somebody else's policy. So please talk to your insurance agent ahead of time and say, hey, I'm looking at a property like this. Can you give me a ballpark of where I'll be? It will be a rental and the deductible I want. I've bought properties before where they show $150 per unit in insurance and our cost is $280. Well, why? Well, at the time we had 1,000 units and these people had 10,000 units and their deductible might be way higher than mine. Or they might even have much worse coverage than me because they have different loans. So you can't compare apples. You have to compare apples to apples. This is not apples to apples coverage. Be very, very sure that when you're buying a even if it's a small apartment building, make sure you're getting your insurance quote up front. And it's as simple as calling your agent up and saying, hey, where am I going to be? And they say, well, I got to figure it out. It's very, very important. For a single family home, it's going to be much more than $150 or $250 per unit. But the point is, you get the idea of what I'm trying to get across here. But one of the most important things I want you to do, revenue. Make sure you understand what the rent in the area is going to be. If you're buying a single family home that maybe hasn't rented before, go to Craigslist and any of the other online, Zillow, Realtor.com, find out what other houses and units in the area are renting for. Make sure you look at pictures. How do they compare to yours? Your job, your goal should be to have the most expensive unit in the area, but you're not going to do that by having a normal looking property. Go do some wow to it. You're going to want to have a nicer property. So if you see all the properties in the area renting for $1,000 a month, that's great. That's dandy. Your goal should be, how do I get $1,200 a month? You have to put some work into it, but try to get there. But one thing having to do with revenue, vacancy. No broker or realtor on smaller properties puts vacancy in. If they do, they put 5%. Guys, it's going to be 10% probably. If you're only getting 5% vacancy, your rent's too low. You should try to get 10% vacancy by increasing your rents. So if they put in no vacancy saying, well, it's a single family home, it's already leased, doesn't matter. If every 3 years it goes vacant for 3 months, that's 8.33% vacancy per year. Because if it's vacant for 3 months every 3 years, that's 3 out of 36. That's 1/12 of the time. That's 8.33%. So don't be that sucker who believes everything you hear on that one. Factor in a vacancy of 10%, maybe 7.5, whatever it is. Don't accept 0 as your vacancy. It doesn't exist. So that's the high level of what you need to look for before you get into a deal. But I want to make sure we're going to do way more real estate videos on this channel as time goes on. So please subscribe to this channel right now if you like this video and you want to see more. So let's get into the numbers of things. So first off, let's assume we're buying a house for $100,000. Now you might sit there and say, Paul, you can't buy a house in my area for $100,000. Maybe not. But the rent I'm going to use an example of is probably going to be a lot lower than the rent you can get your area. So something I always hear from people is take off 2 zeros, and as long as you can get that rent on your property, you're good. So the idea here is take off 2 of these zeros. As long as you can get $1,000 a month in rent, you're all set. Okay, let's do the math here. Let's say you get $1,000 a month in rent. That's $12,000 a year. Take out 10% vacancy. That equals $10,800. Okay, not bad. Now, let's do your taxes. Let's say you're in Ohio and your taxes here are insane. Property taxes, $2,500 a year. You're left with $8,300. Okay, now, one thing that a lot of people don't factor in is maintenance and repair. Because what I hear most of from people is saying, hey, I get $1,000 a month in rent, and my mortgage, tax, and insurance are $800, so I'm making $200 a month in rent, in cash flow. I'm like, well, are you though? What about maintenance? What about repairs? What about when the house is vacant, the utilities to pay? What about when the house is vacant, the turnover? Because guess what? People are going to hurt the house. You have to repaint. You have to go do slight adjustments here or there. So these things all have to be factored in here. So we're left with $8,300 here. Well, let's take out some things. Let's take out insurance. Call it $700. You're left with $7,600. Let's take out maintenance and repair. Let's call it $1,000. You're left with $6,600. You see how this is all going down and down and down? That's fine. It's okay for it to go down and down and down. You want to make sure that you at least understand, because the reality is you're going to have these costs. Now let's put another $1,000 in for miscellaneous costs. Things like, and I'm being very generic here, but things like the vacancy, the utilities when they're vacant, some small advertising costs, cutting the grass when it's vacant, snow plowing when it's vacant, things like that. And they're going to be, some areas have permits. Some areas include trash removal as part of property taxes. Other areas do not. You know, we were in areas of Cleveland and Shaker where, depending on what side of the street you're on, trash removal was included here, trash was not here. So it all depends on where you're at. These are important things to understand. But let's say you're left with $5,600 a year before your mortgage payment. So let's start there. $5,600 per year. Doesn't sound like a lot, right? Okay, that's fine. Let's say you put 25% down. So you're going to put $25,000. You're financing $75,000. On a $75,000 mortgage, financed over 20 years at, let's call it 6%, because if you go buy an investment property, they're going to charge you a lot more than the normal rate. So let's say it's 6%. That mortgage is equivalent to $6,400 a year in mortgage payments. So you have negative cash flow of $800. Now you might be looking at me going, oh my God, that's crazy. Okay, it's just math though, guys. Now don't forget, part of the $6,400 though is you're paying down a lot of debt. So you still have profit. You'll just have a loss of cash flow. And there is a difference. And I'm going to do more videos in the future based on the difference between cash flow and profit. But you're going to be paying down debt. But the most important factor is it's just not enough rent. Don't listen to the chop these two zeros off and that's what you need. I don't believe that at all. Now, in this market, you might be looking at it going, well, I can't even get that. Markets fluctuate. And the same things that work today, that happen today, won't necessarily work during one of the biggest bull markets of real estate in history. Prices are up high, not just for homes you're going to live in, but also for rental properties. We look at deals and go, how are they buying this property? They paid cash to get a 4.5% return, but now they're financing it and paying 5.5% interest. How does that work? Well, they're okay with losing cash flow as long as they think rents are going to jump up more and home prices are going to jump up more. Because on this property, if I told you that the property was going to grow at 6% a year, well, you do this all day. You're going to make $6,000 just in growth of the property value all day long. Of course you do this. But my main key here is to say, don't believe the whole old adage of chop off two zeros, and as long as you get that monthly rent, you're fine. During the pits of the real estate crash in 09, 10, and 11, I was buying properties in Cleveland, not city of Cleveland, in the suburbs of Cleveland, for an average of $8,000 to $12,000 total, putting $30,000 into them. So I was into them for around $40,000, and I was getting $1,000 a month in rent. That's way better. According to the theory, I should only be getting $400 a month in rent. I was getting 2.5 times more. Is that normal? Probably not. But there's somewhere in between. Somewhere in between. There's like a rule I always heard when I was younger that take the home price value, divide by 5, and then divide by number of months. You need to get $1,666 a month in rent. I don't know. That doesn't work in Cleveland because property taxes in the Northeast Ohio area are really high. So it really affects the ability to be profitable. And I don't see options like this anywhere. Right now, for a house that we have, it's worth about $100,000. We get about $1,200 to $1,300 a month in rent. And guess what? We're very happy with it. We make a good enough money for our deal. Now, you might sit there and say still, let's say hypothetically you got this $1,200 a month in rent. So now you're adding another $2,400 a year to your cash flow. So now you're getting, remember before it was $5,600, but now we're adding another $2,400. You're getting $8,000 a year before your mortgage payments. Your mortgage payments were $6,400. Now you're cash flowing $1,600. And you're like, I do all that work for $1,600? Yes, because it's the power of compounding interest. Look at this return. You put in $25,000. You got $1,600. What's your return here? Your return is roughly 6, 7, call it 7%. Not a lot, but you've also paid down how much debt? Of that $6,400 in mortgage payments, you might have, let's say it's $75,000 at 6% per year is 0.5% per month. 375 times 12, you're at $4,400. You're paying down an extra $2,000 a year in mortgage payment in principal. So now your return is $2,000 plus the $1,600 divided by $25,000. Your return just went to 16%. Please rewind that. I went quickly there. What I did here was I split up my $6,400 payment into how much was interest and how much was principal. I did it back of the napkin. I took my monthly mortgage interest of 0.5% because it's 6% per year, divided into 12 months is 0.5% per month. 0.5% times $75,000 is $375. I pay that 12 times a year. That's roughly $4,400 per year. Okay, my mortgage payment was $6,400. $4,400 was interest. That's $2,000 of paying down my debt. And that number is going to go up and up every single year because every year you pay down that $75,000, you have less interest charge. So I have to add that return because I'm paying down debt is the same as making profit. You have less debt to somebody else. That's now part of your net worth. 2,000 plus 1,600 divided by 2. That's 3,600 divided by 225,000, 16%. But we're not done. Your property also goes up in value. So let's remember this. We have 3,600. We have $2,000 in profit from paying down debt. And we have $1,600 in cash flow. Now, your $100,000 property goes up in value, right? Real estate goes up in value. If you buy it right, it'll grow in value. How much? Let's call it conservatively 3% per year. That's another $3,000. So now you're at $2,000 plus $1,600 plus $3,000. You're at $6,600 in profit. And what was your investment? Remember, guys, your investment is only the money you outlay. It's not the $100,000. A brilliant real estate guy once tried to tell me it's based on $100,000. He is wrong. So now your $6,600 in profit is off of your $25,000 investment. What's your return now? 25%, something like that? Is that worth it? Here's how it's worth it. Let's be conservative and say you screw up and you only get 15% a year. 15% a year. Okay? 15% a year, and you do one deal per year at that level, and you invest $25,000 a year. So you're going to do $25,000 a year, 15% per year for 30 years. Equals $10.9 million in net worth. Now, you have to pay taxes along the way, of course, but the whole point is you'll also get tax deductions along the way for owning the real estate. This is an incredible way. 30 years doing one good deal a year. By the way, that's a good deal. That's not a great deal. That's a good deal. If you're able to make that 20% per year, just by being a little bit more conservative, because remember, you're only trying to do one deal a year, that becomes $30 million. So if you make 20% a year, you get $30 million. That 5% extra a year gets you almost triple the money. Now, there's work involved. There's a reason why real estate has higher returns. One, it's illiquid, right? You can't, if you want to sell a piece of real estate, how long does it take? Heck, it takes a few weeks just to list the property. So it's not liquid. If you want to ever pull money out of it, it's going to take some effort. It's not like a stock account. Oh, I want my money out, sell, and I'm out in seconds. Real estate is illiquid. Two, it takes more work. With stocks, you're not involved in the company. If you own Microsoft stock, nobody's asking you to do work. You're not doing anything. With real estate, you're doing the work. Speaking of the work, the biggest thing I want you to do is this. If you think you're going to manage the real estate with a third-party real estate management company, just don't even bother investing. You'll be disappointed. I've hired so many real estate property management companies and never found one. In 4 different cities I've looked at, I've never found one that was good. Their goal is just purely, how do I keep the property full? How do we keep the rents low to keep the property full? Your job is to get the rents higher. Nobody's going to handle your money as well as you are. So if you really like this video, I want you to remember, real estate's a big portion of this channel and it'll get bigger as time goes on. Part of our software is going to have a real estate analyzer tool, similar to the stock analyzer tool, where it'll tell you what to pay, what returns you can get in the property based on what you're paying for it and the expenses involved. Subscribe to our channel if you like this and watch our next real estate video that I want you to watch right here. Thanks very much.